Okay, hello and good afternoon. I welcome you today here with a special webinar exclusively for JFD brokers, how to trade the market opening of the US markets. Yeah, I'm really happy to be here today. So to guide you through the next hour, we have probably something, not necessarily the US markets open ahead of us here, which is probably kind of exciting. Let's see whether the S&P will make it above 2,500 points and the Dow Jones probably finally making it to new all-time highs. But some of you might have also seen what's going on here in British pound, for example. So I've seen plenty of comments over the last weeks here from people asking around the FX markets. And sure, I mean, it was kind of clear that the British pound sterling here would be in the main focus today with the BOE rate decision here. And in fact, nothing spectacular happened here. By the way, I'll guide you here through this strategy for the Dow Jones S&P here a little later on. First of all, let's have a look here at the GBPUSD first. I think this is definitely worth a watch here. So I have to say that it's not surprising to see the Bank of England not raising rates today. So that wasn't a big surprise. That could be expected. But now the thing is that I was quite sure, to be honest, that their rhetoric stays neutral as well, similar to what happened here last month here. When many market participants expected the BOE coming out quite hawkish today. And oh, by the way, 1 second. Okay. So in fact, that had also something to do with the numbers yesterday. We've got presented here. 1 sec. Oh, I'm sorry, that's not the right one. I have to prepare one window here, and there, let's go over to trading economics first and have a look here at the numbers. So and there you can already see it. BOE set to raise rates. That's the thing. That's the key here. But that's something we'll have a look at in a few seconds, a few minutes. But first of all, let's have a look here at United Kingdom and the employment numbers from yesterday. So here. That's, by the way, it's an enormous source of fundamental data here, and I highly recommend this website, tradingeconomics.com. It's completely free, and you can get plenty of numbers here around inflation rate and everything, and not just around the United Kingdom and United States, Euro area, and so on, but about all countries in the world nearly. So really great information source here. Highly recommended. And now let's have a look here. First of all, unemployment rate. Well, that was a good number. We dropped lower. We came in at 4.3% here. We're expected at 4.4, by the way, and at the same level as the month before. But, and this is the thing, we had the wage growth. I just hope that this is the right. Yes, that's a perfect number. Wage growth numbers disappointed. So they were expected to come in here at 2.2% yesterday, but came in excluding, but also including bonuses here at 2.1%, showing that the overall wage growth, while inflation picked up, and that was a number we already got to see here last Tuesday. 1 second, where do you have it? Prices here, and then let's go to the CPI or the inflation rate, whatever. So here it came in at 2.9%. Also, core inflation ticked higher, and now imagine while wage growth is ticking lower, inflation is picking up. That I'm not talking about stagflation yet. I think this is far too much and too aggressive here. But all in all, nevertheless, such a development is never a very good sign for an economy. And that's one of the reasons. Also, I don't think the numbers yesterday in terms of the employment situation in the UK were a game changer. Nevertheless, I thought that it could probably result in a more in a more defense way to talk today on their rate decision here, similar to what happened here last month here in August. And that was one of the reasons why I said, well, probably it's not just that we don't get to see no change in rates here. That wasn't a big surprise, but also a very defense rhetoric here. And that was one of the reasons why I was a little skeptical about GBP for today. I really hadn't it on the agenda that then the Bank of England comes out with the following quote. And by the way, I already prepared it here. So just have a look here at my Twitter account. By the way, if you want to follow me on Twitter, you can find me at Jens Klatt at Jens Klatt FX here. And as you can see here, the last 3-4 quotes or tweets from my end came in at majority sees scope for stimulus reduction in coming months. And that's, by the way, that's probably the key phrase here. That's the quote which led GBP shut through the roof on a broad scale here, not just against the US dollar, but also against all other currencies today, and making the pound sterling the outperforming here. So that's exactly what here at the website tradingeconomics.com is meant by BOE set to raise rates here. So they are obviously about to reduce their stimulus here in the coming months. So probably they're about to hike rates in the upcoming months here already. And that's one of the reasons why GBP right now is accelerating here on the upside. By the way, and this is the thing, you have to also take into account here that this is really strong. And I'm not talking about strong, but really strong. And this has something to do with the numbers we just got to see around US inflation, which came in higher than expected. And also here, calendar indicators, United States. And there we go to the CPI inflation rate here. So consumer prices in US increased 1.9% year on year in August. These are the numbers right now, and they came in above expectation. So US dollar right now is really gaining some strength here. You may have seen yesterday, for example, dollar Japanese yen aggressively pushing higher after already seeing higher highs here. We had already a very strong opening into the week, Monday, Tuesday, and yesterday accelerated again. You may have wondered what happened here in euro, for example. So euro just pushed lower yesterday, and the main reason was that high yields here in the US just ticked up, and that was something I presented, by the way, already in today's morning meeting, but also in the everything. Oh, cool. Okay, that didn't work. So hi, that's me. 1 second. So now here's my chart again. Okay, now it works. Okay. So let's just have a look here at the yield development in the US. By the way, also something which could have kind of which could influence the developments in the US equity markets today. But first of all, let's have a look here, what I'm talking about in terms of yields. Oh, I'm sorry, not this one, here. So this is 10-year, yes, this is 10-year yields T-notes. So we are looking at the T-note future here and here at the yields. And currently, we're ticking higher at 2.2%, which is significantly higher than the lows which we made last week when we traded around 2.04%. 1 sec, please. Okay, so and so that's this development here. So US yields ticking, in this case, 16 basis points higher from the lows of last week. So 16 basis points is just 0.16%. You might say, well, this is not much, right? But in the yield markets, this is huge. So in the bond market, such a move is really, really strong and shouldn't be underestimated. And if you look at the developments, for example, here, the US dollar, not just in the Euro USD, but also dollar Japanese yen, you can see that this had already quite aggressive impact here on the market and pushed dollar yen up to 111. But we didn't make it above that level. But right now, just spiked higher and now are sold here again. And so I'm not sure what to make out of this right now. But what we can definitely say is, or we have to, yeah, but okay. So I'm just seeing that some people have sound issues, but everything seems to be fine here. So probably, 1 sec, just try to update the site. Clicking F5. Probably that works. So sometimes, sometimes people have issues while no one else has issues. Me too. Everything seems to be fine, and then it has something to do that you have to reload the page. Just reload the page, and then and it just works. Okay, so now the question is, why isn't dollar yen pushing aggressively higher? And it's kind of interesting reaction here in the US equity market. So if you look at what's happening here at the pre-open phase in the S&P, I mean, we don't get to see much action. That has mostly to do with the fact that European equities are just horrible to watch today. It's just horrible to trade, but it's also horrible to watch. Just see what the DAX is delivering here from the beginning of the trading day. So some volatility coming in thanks to the drop in Euro USD to new daily lows, pushing the DAX higher here, and now getting sold off again back towards 12,500 points. Now we're pushing up again, and we are trading in a range here of 40 points, nothing more than that, 41 points. And that's really, really uncomfortable to watch, let's say. And that's one of the main reasons why nothing is happening in the US market so far. But what you can clearly see here is in the especially in the S&P 500. Look at the development here in this candle. So this is the candle right before the US inflation numbers are published, and then also the candle here at in this case 12:30 p.m. GMT. So why is that happening? So why is, I mean, we're not talking about much. This is ridiculous. So we're talking about 3 to 5 points. This is nothing. But the thing is, the question is, why is the S&P reacting bearish here on positive inflation data, respectively on a stronger US dollar? And I think the main reason for that is because market participants probably start to fear the Fed coming out more hawkish next week than on Wednesday, and probably fearing that there might be kind of restrictive rhetoric here, which could, or hawkish rhetoric, which could then diminish the outlook here for the equity markets in general. Here, look at the Dow Jones, for example, for probably pushing the US dollar higher again, resulting in negative side effects here in the export sector. And if you have this fear here, this could result right now in a more choppy outlook for the upcoming days, probably in a more corrective outlook, meaning that we could probably push lower from here instead of stabilizing at the current levels. By the way, 1 sec, I have to just here. So if we look at this, we have to take this into account here and really carefully watch how the US dollar and also the yields develop here in the next hours, since this could have a negative impact here in the S&P, also in the Dow Jones, and resulting in holding both back of making new highs. In terms of the Dow Jones making new highs here, higher than 22,200 points, and breaking to new all-time highs, while holding the S&P 500 back here to, not just to recover those small losses here in the pre-market open phase, but also making it above 2,500 points. Nevertheless, all this is just pure speculation, and at the end, the price action decides what we will do here, and we have a clear and predefined setup, and we'll just trade the setup. By the way, I've already prepared something. You might have wondered what I could have prepared. So what I did so far was I just traded the setup I presented last week to you for the last week of trading. So now you might wonder, you might say, hey, so if it's 7 days ago, we had 5 days of trading and there's only 3 trades here. How can that be? That's very simple. There are several reasons. I could now, and this is something I copy pasted here from my MetaTrader, from my JFD account, and just posted it into this Excel file here. And I've already taken out all the trades which were canceled, for example, or I already took out here all those orders which weren't triggered during that time. And on top of that, I have to add, I have also one filter here where I need to have a trading range, an open range of more than 5 points here. So if this is not the case, I'm not getting an order in the market here. For example, yesterday, I hadn't a trade in the S&P. That's only to do with the reason that the trading range yesterday was too small. So if you look here at, for example, the open range from yesterday, what we can say is that here in this candle, already at 1:30 p.m. GMT, we had the low at 2,491.1, and then we had here the high in this candle, which was at 2,495.91. So, and that means the open range was just 4.8 points. 4.8 means we are not having it, or 4.8. It's we didn't had an open range of 5 points, so we had no trade yesterday, and that happened twice over the last 5 days of trading. And this is the result also from the trade last week. You may remember we had a live trading event last week here too, and I formulated a setup. And I traded the setup as formulated during this event here. And what I can say is that the result last week was negative, as was the result, for example, then from Friday, while we had a small profit here on Monday. So that all in all, you might say 3 trades. Okay, that doesn't look promising, right? You might say, hey, he's behind there. And some people might listen to that right now and might say, well, this is obviously just a strategy he might have found somewhere in the internet, publishing it here, and that's it. So no, it's not the case. So that's something I can definitely tell you. And what I want to do here is not just formulate a trading setup and then just leave you with this and just tell you, okay, no, trade it or leave it or watch this video and be entertained here. But the thing is, I really want you to profit from this content here. So that's the main reason JFD brokers and I why we're doing this special webinar here, this special series, to really let you profit from this and really see how this can positively affect your trading the long run. And it doesn't mean that you have to trade this strategy. That doesn't it's not necessary here. But you can, and this is the main reason. But the thing is that you probably get an idea of really how to, and that's the topic of this webinar here. That you get an idea of how a pro trader trades the market opening, respectively trades in general. It's not just the market opening in certain markets, but it's the market opening in general. So what makes me a pro trader? The fact that I'm managing clients' money, for example. So I'm trading a managed account under a licensed umbrella, and you can check my statistics, for example, my trading performance on my website. And it's not that I'm I try to double the account in less than 1 week or something, guy. No, the thing what I try to achieve is really that my managed account acts as kind of investment for the investor. So that means that I have a very, very strong and strict risk and money management plan here, and I'm not risking more than 1% per trade, for example. So in fact, the average risk per trade I take is 0.6%. And all this combined, having a trading routine, having a clear trading a plan in terms of risk and money management, but also have a mental stability here, trading psychology, all this combined makes the long-term profitability in trading. So you might have seen several other webinars from me, for example, on the 3 columns of profitable trading. It's not just that I talk about this, but as you have already seen here, it's not just that I talk about it, but what I try to do is also not just to try to do, but what I do is that I really trade what I tell the people, and that I really behave the way I do, and that way making this as authentic as possible. So now let's come back here. Let's come back here to the definition of the open range breakout setup. So you might probably wonder, why is there something missing here? For example, this filter I just brought into play here when I said 5 points. The range has to be, the open range has to be 5 points, for example. That's something I included in this setup. This is a basic setup if you want, but it doesn't necessarily mean that you have to include it there as well. But it depends on you if you really want to include it or not. If it fits your style of trading, your personality, and all this. This is really important. Also, what I teach my students, for example, when they take me as their mentor, that I tell them, hey, trading is something really individual. So it's not sad that you can just duplicate what someone else is teaching you. So there might be several other trading coaches, or some might call them gurus out there, just saying, hey, here's the strategy, just trade the strategy, you'll be profitable. But that's not the case. That has nothing to do with trading. So trading is a business, and as every other business out there, you have to find your personal way of doing business and what fits your personality best, and what is fun to you, if you want. So you have to really love what you're doing. So there, you really have to love trading if you want to be successful here. It's not necessarily about the money. It sounds ridiculous, but it's all in all, it's about the money. It's just about the money. It's a performance indicator. As more money you make, as more successful you are with your trading, well, that means the more profitable you are, right? But this is exactly the thing. So it's really individual. So don't be surprised to not find this filter, for example, here. So it's only the basic setup there. So what we do is, or what we will do in the next 45 minutes. It's not an hour from now, 45 minutes. So we will already be done with this webinar here once this setup is defined, the open range is defined, and we'll get to see where we have a predefined setup then, which we will trade. So we'll have a chance to see what happened to this trade next week then on Thursday. And nevertheless, you can copy paste this here. You can just screenshot this and try it yourself, the strategy. And the main reason I say that is because I strongly and firmly believe that having a trading routine, a clear plan, a clear game plan you go through every day is essential to become profitable in your trading in the long run. Why is that? It's very simple. It has something to do with the fact that trading is really abstract. So, and I wouldn't be surprised if most of the people listening to this video right now might say, hey, having such a routine would be really great, because I'm always very nervous, very excited, so very emotional when I'm sitting in front of the screen, seeing the market ticking up, ticking down, and not really know what to do. And this is one of the main reasons why you have to have a clear plan. And it's not just to have a clear plan and say, okay, if the market does that, this and that, then I just go long or go short. But also you have to prove that what you're doing is profitable. So what you're doing has a positive expected value. And this is exactly what this setup does here. So we identified the open range here on two ways. Well, we will work with the way here. We're working with the 50-minute exponential moving average in the aggregation of 10. So by the way, I'll rewrite this here. 1 second, please. Let's just see. I think that makes more sense, or that looks better, because everyone can then understand what I'm talking about. 1 second. So here, let's put it that way. So we identify the open range. We identify the advantage first. That's the first thing we do. First step we do. So we say, okay, it's the 50-minute exponential moving average. We trade below that, we only go short. Right now, it looks as if we are trading around it. Let's see where we trade around 45 minutes from now. For example, yesterday there was no trade, but let's see what happened here, for example, on which day is that? It's Monday, right? And as you can see already, so that was the day when the market obviously generated a profit for us. And we entered our trade here when the market broke to new daily highs then. And obviously we went long because we were trading above this yellow line. So the yellow line is the exponential moving average 10 here on a 50-minute time frame. And that's how we identify the advantage. What we could also do is do this from a discretionary perspective. So meaning that we could say, oh, I'm sorry, let's do it that way. Let's go here and just say, hey, obviously we are long. Why? Well, higher highs and higher lows. That's Dow theory, simple Dow theory, really rough, but we are long. Some might say as long as we trade above 2,445, some might say 2,420 points around this region here. So now you might say, okay, we are long, so we only trade long, but this highly depends on where we trade here in terms of the distribution and accumulation area, for example. And here we made it to new highs over the last days, which could mean that we are currently trading in a so-called distribution area, which could mean that we are on the long side, but we should trade it with a reduced position size since the risk rewards on the upside are getting unattractive. So what I mean by that is can simply be understood here with this picture. No, it doesn't work. It's a little unfortunate. So let's do it that way. So how to find the advantage? So this is the discretionary approach. Oh, by the way, I thought I changed this. So I've translated my online course into English, and that's one of the reasons why I was very, very happy to have it finally, since this is obviously German, but I have this chart here also in English. Okay, let's leave it the way it is. So the thing is, here this red area is called the accumulation area, while here the green area is called the distribution. I'm sorry, the other way around. I'm sorry. So the green area is the accumulation area. That's where you accumulate the position. And the red area is the distribution area. This is where you try to distribute what you accumulated here. And this is usually very rough way of putting how professionals build their positions. So just imagine you're a big institutional trader, and you say, I'm buying the break to new highs here, for example. The problem you might have then is that there are several other people who want to buy in this region for several reasons. We don't go into too much detail here right now, but this is one of the reasons why these people try to accumulate the position already here in the so-called accumulation area, and then try to distribute it here where most of the people say, oh, we have finally made new highs. That's something like similar to what happens in Bitcoins right now. Everyone wants to buy Bitcoins the moment it broke above 5,000, let's say, or something. And usually it's not unusual. It's not unusual that the market breaks to new highs here. And then finally, when you find out, okay, obviously it's a good idea not to buy for whatever reason, because everyone is buying Bitcoins or whatever, that the market then sees a pullback. So just imagine this is also what's happened here, for example. Market is making new highs. Probably some might have bought here around 5,000 and are now seeing Bitcoins dropping sharply and as down as 3,500 USD, for example. So the thing is that you usually try to buy or to anticipate such breaks. And if you buy here, I mean, however you might do this, but if you plan to buy here and see the market breaking up, while all the others finally see, okay, the market is breaking to new highs, you start to probably sell what you accumulated here in this area. And that's the reason, that's the key reason why you don't want to buy here in this red area. Sometimes the market might go parabolic here, and you might just be really unhappy to see that you just sold your position somewhere here, and then the market is squeezing aggressively higher. But all in all, you can say that in the long run, you will be far better You're making far more money if you really try to anticipate such breaks and try to sell those positions here in the so-called distribution area. And this is how you could also find the advantage. But the thing is, I don't want to go into too much details here. So what we will do is we'll identify our advantage based on the exponential moving average on 10 here on a 50-minute time frame. And then we do the next simple step, we define the high and the low between 1:30 and 2:15 p.m. GMT. So what we will only do is look, where's the high here, where's the low, and then say, okay, if the market breaks in direction of our here identified advantage, then we'll go long or short, depending on the identified advantage, putting the stop above or below the high-low of the range, and that's it. And finally, as you may have seen here already, but I will guide you through this now, you can also work with something, a time stop here. I'm taking out the trade at, in this case, this is German time, by the way. So this is 6:50, yeah, 6:50 p.m. GMT. I'm taking out the trade automatically. So I don't care what happens in between, but I just say I identify the range between 1:30 to 2:15 p.m. GMT. I identify the advantage going long if the market trades above the exponential moving average 10 on a 50-minute time frame, or short if it does the opposite here, trading below that. And then I just trade the break. And what I do is I take out the position here at AM 6:50 p.m. GMT, and that's the setup. As simple as it sounds, but this is the setup I trade here. And now the thing is, some might say, I'm not sure whether I should trust this. I mean, this is the thing. I want to show you. First of all, I want to show you a graphic here. Something I've presented to you already last week. Where is it? One sec. I just have to see where I have it. Here. That's the picture. So I've presented this to you already last week, and I mean, this is really promising, right? It perfectly shows that obviously it's obviously running from the left corner here on the downside up to the right corner on the upside. That's usually showing an uptrend, and this is the equity curve. So obviously we're making a lot of money with this system, and this is the system is making money now for nearly 7 years, and it's a simple setup. So what I just described here, and where you might just shake your head and say, hey, can this really work? Yes, it does. This is the setup based on which this equity curve here was created. You can see here the 10, this is the exponential moving average. We are looking at 1,347 trades. And what you can see here is also the average profit, the average loss, and all this. But now the thing is, and this is what I presented already to you last week, just imagine the following. You listen to what I had to say last week, and then you say, hey, this is great. This is a trading strategy I could just duplicate here, just trade it. By the way, you might now have had a look here at your clock and might have seen that the opening had already took place in the US. But in fact, this is exactly what I was talking about when I meant if you know what you're doing, you're not getting excited here. And I don't need to watch every tick now since I have a predefined setup, and the first time I'll look at the chart will be probably somewhere around 2:10 p.m. GMT. We don't really need to look at it right now. But let's come back to this here. So you look at these rules I just described. You just look at this chart now, and you say, hey, that works. And then you started to trade it. And you might, let's just say you also had, you might also have said that you only want to trade once the open range is 5 points. I mentioned this already last week here too. So you had 3 trades. So now you see the result here. By the way, this is a 10,000 euro account we're trading. And so you might have wondered why the lot size here differs that much. I predefined that I said I'm risking 1% of my equity per day. So 10,000 euro means 100 euros here. If you multiply this by, let's say, 10, trading 100,000 account, then you getting 10 times higher amount here you're buying. But the thing is, what is interesting for us is here, look at the result of the last 7 days of trading. It's negative, right? And some, as already said, might say, hey, this looks so ridiculously easy, and now I get a result of minus, in this case, 62 euros. It's not much. I mean, that's not a catastrophe here, but nevertheless, it's negative. And it might result you saying, hey, I'm not trading this setup anymore. That doesn't make sense. It doesn't make me any money. I had 3 trades, even though there might have been one winning trade here, but all in all, the result is negative, so I don't want to trade this anymore. And this is exactly where profitability and thinking in terms of expected value comes into place. So what we've already seen last week here, and that was, I will also open it here, editor. 1 second, please. Okay, so what we can do, if you have a solid understanding of key parameters here around risk and money management, you can, for example, profit, also profit from, but especially you can work with this formula around the expected value, which goes like this. Average losing trade, and you multiply this with the loss rate. So, and thanks to that, you can calculate the, I shorten things up here, so I make expected value EV. So you can put in the numbers here you got for 7 years of testing the strategy, saying the average winning trade here is 1.0. This is an 8, yes, 1.08. It's the average winning trade. You multiply this with the hit rate. It's the win rate here, 47%. I'm sorry. So put it that way. And then you subtract the average losing trade. Obviously, so you can't be above 100% here. So if you have 47% winning trades, that means you have 53% losing trades. And then you just calculate the result, and it's, oh, by the way, I think I made a mistake here. Did I do a mistake? I think so. One second. I have to look something up here. Let's change this. I think that makes more sense then. Let's put it that way. So I just divided the average profit by the average loss. This is weird. Huh. Okay, this is interesting. I think this shouldn't change, but it changed. Just okay. However, so what I just did was I divided the average profit here by the average loss. So that's something we call the payoff ratio. This is like the average winning trade divided by the average losing trade. And then you get 0.61 and you subtract 0.53 and you get below, you get 8 cents, which is profitable, or showing that you're making 8 cents per every euro you risk. Okay, so that's positive. And what you see is that the expected value obviously is positive. So you can see it works in the long run. But now the thing is, from a mental perspective, this result over the last 7 trading days is it's not very promising. It's not very promising. So what you can see is that it's negative. And if you just listen to what I had said last week, we might have said, well, it doesn't work. So what I did was I said let's put it that way. 3 trades are not enough to say whether a trading approach is profitable or not. This is very important here. And remember that. Please remember that all the time. There are plenty of presentations I held here, especially in Germany, and many people whom I ask, hey, are you profitable in your trading? They say yes. They nod. Yeah, I am profitable with my trading. And I said, okay. And how do you define profitability in your trading? Oh, yesterday I made 2 trades and turned a profit. It was really great, so I'm profitable. But this has nothing to do with profitability. As this result here is negative, it's obviously, if you look at this chart, at this graphic, and at the numbers we just drew out of 1,347 trades here, it's obvious that this result over the last 7 days does not show whether the strategy is profitable or not. But obviously the strategy is profitable, but turned a loss over the last 7 trading days, or 5 trading days in this case, over the last 7 days, so the last week. So what I did now was I took, for example, the numbers from the 1st of August here, and also you can see here, we didn't trade it through. So there were several times when the setup wasn't triggered, thanks to a too small open range, for example, or because the order weren't triggered, since the market probably had a quite wide open range, but didn't break out of the range then in the next hours of trading. But what I did here was I just had a look at the result from the last 1.5 months here. What happens? So obviously, even this is not enough. We are talking about, in this case, we're talking about 20 trades here. So it's nothing. It's not much more than those 3 trades, even though it's more, okay? But it has nothing to do with the long run compared to what we had here, for example. The 1,347 trades, those 20 trades doesn't really matter. So it could be, I had to look it up myself now, but it could be that it was just a losing streak here. It could be that after 20 trades, it could be that you just lost 20 trades in a row. It's just part of the game, but all in all, it doesn't change the overall profitability of this trading approach. And now the result is really impressive. In fact, it's showing a profit here of, and remember, it's a 10,000 euro account. So it's showing a profit of 5%. So you're making 5% with this easy strategy over the last 1.5 months here. Does this mean that this is duplicable now for the future? No, it doesn't mean that. So what you have to do, for example, now is to really look up how realistic is this? I mean, for example, look at the hit rate here. Look at 1 winning trade, 2nd, 3rd, 4th. Break-even trades, but both of them are counted as winners here in this case, 6, 7, 8. So, oh, by the way, this is great. This is really great. So it's 8 winning trades, while it should be 1, 2, 3, 4, 5. Oh, I'm sorry. Yeah, sure. Okay, let's put it again. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and here's the 11th one. So we just said it's 20 trades, for example. Here we just looked at 20 trades, and we had 11 winners, which means our hit rate over the last 1.5 months was 55%. Right? 55% hit rate. That way. So what does this mean? It means that in terms of the hit rate, we are obviously above expectation here. So what we can say is usually we should expect 20 trades to turn on average something like 9 winners. Sometimes it's probably 10, but all in all, it should be 9 winners. Now we had 2 winners more. You might say, hey, come on. I mean, these two trades here, I mean, they are break-even trades, yes, but this is not the way you should do your research here in terms of your trading, but you should look at the biggest winners. The biggest winners are this one here, 184, and here 120, 84 and 24 here. So if you sum these two trades up, you get over 300 euros, which are making over 60% to this, or bringing over 60% to the overall positive performance here. And if you cut those two out here, you will see that the overall result is still really profitable. It's more than 2%, but all in all, it's you just made it more realistic, or this is exactly what you should aim for in your trading. Don't go for trading approaches, and don't try to be the guy with the best trading performance in the room, but be really conservative here. Always cut your expectations down. This is very important also from a trading psychological standpoint. So in fact, what we're doing here is we're working with numbers. We're heavily working with numbers here. But the thing is that, in fact, if you read between the lines, you can see that I'm more referring to trading psychological aspects here. It's not about expected value or something like that, but these are just the numbers. You have to use them to bring your overall trading to a more stable, from a mental perspective, to a more stable level here. And really reduce your expectations. And doing this will bring you to a point where, if you cut down your expectations, and if you take out those big winners, for example, here, where you can just say in the end, or where you cannot just say in the end, but where you will probably come to the conclusion that the trading approach itself is still very profitable. And this will give you some enormous what's, by the way, the word for being calm? I mean, it's calmity, or it's calmness. Let's just look this up here. In Germany, we call it Ruhe. I think we can say calmness here. So it will definitely calm you down. So I'm not using this word at all now, but it will definitely calm you down in your trading. And that's one of the reasons why I still have no real problem to not have looked at what the market is doing right now here around the market opening. We'll do it finally. So we have 10 minutes left here. So let's have a look what the S&P is doing. And it's coming in very, very stable and above the lows from yesterday. So recovering most of those losses here. And here is the opening. And let's just see where the open range is so far. So it's the low, it's 400, it's the exact same low as yesterday, by the way, 491.1. 1 sec, let's do it here. So SPX open range. So by the way, this is not the final open range. We have definitely to wait for the open range to finally develop here. By the way, I have to switch the comma and the dot here. And so here's the high. So in fact, the open range so far is just 3 points. So if this, if the open range is not extended by another 2 points, we're not getting a trade today again. Or I'm not getting a trade today again. Some might say that probably it's enough to see such a range here. But the thing is, some might wonder why I'm working here with such a filter that has something to do with the spread. So if you're trading CFDs, you also have to take into account the fact that here you have 0.3 to 0.4 points spread, and let's just assume that you're having a 0.4 point spread here. By the way, we can also switch over here to the website from JFD Brokers and just have a look where the spread of the liquidity providers is here. So JFD, by the way, has no market making license, meaning that, let's take the English website, meaning that they have no conflict of interest here. And so that's very, very important, in fact, when you trade the markets, since especially trading CFDs, for example, there's lots of stories around stop fishing and all that stuff. And when trading with JFD brokers, you're completely anonymous here, so no one can see your orders. The liquidity providers are external liquidity sources, as in, for example, the FX business here, when you're working with a no dealing desk. So in case of JFD, it's not just in terms of the FX markets here, 100% STP and DMA, but it's also in terms of the CFDs, 100% STP and DMA. If you need any further infos on this topic, just send me an email here. So to Klatt. One second. Klatt at ak-trading.com. I can send you further information here on this topic. And now let's have a look here at the Dow Jones and so on. And here the minimum trade size. Do we have the spreads here? Here are the spreads, and in our case, the S&P. As you can see, typical spread 0.4. What is meant by typical spread? Typical spread means a liquidity provider depends on the volume and the liquidity in the market. And if the liquidity thins out, spreads can widen here, as they usually will around NFPs, ECB, Fed meetings, and all that stuff in the FX markets too. That's also true here for the liquidity in terms of the CFDs. And so it's 0.4 points here. And now imagine you're only having an open range here of 3 points. So then the spread already makes more than 10% of this overall trading range. And that's just too cost intensive, let's call it. It's just too costly here to trade with such a spread here in such a tight range. And that's one of the reasons why I want to have a range, a trading range of 5 points and more than that. And why I need a trading range of minimum 5 points. On top of that, I also want to reduce the chances of getting stopped out by a coincidental spike or something like that. So yeah, if you have wondered that why I want this, I mean, this is a perfect example right now why I want to have a bigger range here. And let's just hope that the market will do those 2 points. Else we don't have a trading setup then. And yeah, so I can tell you this. We again made theoretical input here a higher topic than the trading itself, since we have to have patience here and wait until the first 45 minutes of trading are over. Since then we have the chance to formulate our trading setup, which you can see already here. This is, by the way, great now. Now it's pushing it up another 0.5 points, still 1.5 points to go here to have a trading range which we can trade. And then you have just a setup. So what we will do is we wait for the open range to be defined here, and then we just look whether we're trading above or below the 50-minute exponential moving average 10, and then we just trade the break in direction of our identified advantage. And in fact, that's it here on the setup. Now let's just have a look here in the chat box. So some might probably wonder where to get all this input here on a trading education and that stuff. Also, therefore, just shoot me an email or contact me via Twitter. So as already said, I have an online trading course. I created it, and it was mainly based on the fact that this is not my first webinar here on FX Street, and several people just contacted me after they watched me talking about the markets, trading the markets here and that stuff, and just said, hey, do you offer something in English too? And that was kind of wake-up call, let's say. And my website is still in English, so I'm right now working on getting an English one here, but you can find it here via Ausbildung and then online. It's English. Okay, and there you have the Trade Like a Pro online course. And if you want any more information on that topic, also just shoot me an email. So probably this is something which is interesting for you. I think the main thing is, and hopefully I was capable of making this clear here in the last 45 to 60 minutes, that profitability in trading is not just about having the right setup, but it has a lot to do here with things like trading psychology, but also knowing certain things like sentiment in trading, market structure, Dow theory. So all in all, you might say, hey, we have an uptrend, so we only go long. But the thing is it really that favorable here to trade the long side in the S&P when we look at the fact that currently we're trading in the region around the all-time highs? And we obviously broke to these all-time highs here already 2 to 3 days ago. We are obviously trading in a region we should call distribution area. So do you really want to go aggressively long here? I'm not that sure. On top of that, nevertheless, it doesn't necessarily mean that now you should look for short engagements here or shouldn't trade the long side anymore, because this has, on the other hand, something to do with volatility in the market. Let's just have a look here at the current volatility we find in the market. Let's have a look here at the VIX, for example. When trading the S&P, we look at the volatility index here. The VIX is trading around 10 again. So I'm not saying it's collapsing, but obviously we're again here at a very, very low, or we are currently again in a very volatile market environment. So what does that mean? It means nothing more than obviously the market right now is not really willing to show any signs of excitement, nervousness, or something you definitely need, panic. You need to get to see a sharp drop here, or a sharp intraday downward sequence to develop here. That's one of the reasons why I think trading the long side is still to be favored here, and it's still worth to look for long engagements, even though I completely understand some people saying, hey, we already rose that much here, so probably we should at least reduce the position size then a little. So that said, for example, let's come back here to what I just presented to you. Just look at those numbers. I said they coincide here with 1% of risk I usually take on these positions. Well, probably we should reduce this to 0.6, 0.5% to avoid, if we are caught on the wrong side of the trade here, to avoid to have a too big losing trade. Now, and this is a great thing, and I hope this is exactly what in the long run will become clear when listening over and over again to the input I deliver, that all these columns, they interact really strongly with each other. So it's not that they stand alone and you say, hey, now I have all the input I need to become an expert on, let's say, risk and money management. Well, now I can trade the markets. Or now I'm expert on trading psychology and I'm mentally stable here, so I can become profitable in my trading. But the thing is, these columns, they interact really strongly with each other and they play with each other. And the thing is that, for example, what I just said, it's not just very good from a mental perspective, but also from a profitability perspective. Imagine you're now reducing your trading size here by 50%, and you're just risking 0.5% because your research and your knowledge about the market structure leaves you with the fact that you say, hey, you know what? I don't think that we have that much more potential on the upside, and I think that we're probably about to see at least a drop here on the downside. We are trading in the distribution area. And if I reduce the position size and reduce the overall potential average loss I could face, well, what will happen? It happens that this number here, which you subtract when calculating your expected value, that this number here, average losing trade, will drop. And this is how you can now understand, or where you can start to understand what professional traders usually mean by saying, try to make your average winning trade big and try to reduce your average losing trade. You see what I'm talking about? So if someone tells you, hey, write your winners and cut your losers short, you might say, yes, I've read this thousands of times in all the trading books available out there, but no one really knows why. It only has to do with this formula here around the expected value. This is the reason why, because you can see that average winning trades will usually increase if you ride your winners and let them run, and if you make them big, that the average winning trade will get bigger. While if you cut your loser short, well, average losing trade will drop. And this is the reason why this is sad, and why this is so true, since this is the key to profitability in your trading. And probably with that, it's time to just let this event end now. If you have any further questions, please yeah, shoot me a mail or contact me via Twitter. It won't be the last event here, so next week I'll be back again here. And next week, let's see how the overall approach did so far. As already said, you can easily duplicate this. You can easily look at this yourself. But it's not just no, it's not just, but it's not meant to just duplicate it and say, okay, I have a profitable trade strategy now. I will just trade it and that's it, and become profitable in my trading. But be aware that this is exactly not the reason why you should duplicate it, but it's because you should work out a trading routine and get this level of calmity here, this calmness in your trading, to really relax and try to really to only to be. Let's call it that way. This is what you try to achieve. You only want to be here and make trading a routine here, as driving a car, for example, is a routine. So, I mean, I can fully understand that most of the people out there might say, hey, it's great if I can, I don't know, 160 miles here per hour, yeah, sharply break into a corner here, and just imagine how great it would be to drive a Formula 1 car. And it's really exciting. Yes, in fact, it is. But in the long run, and if you want to come safely from A to B, probably it's better to have a routine here and to have a certain level of calmness here. Yeah, to come from A to B here over a long time, and not just for 3 days, and then at the fourth day, I don't know, kissing the next tree, let's say. So okay, that's it from my end. I hope you enjoyed this webinar. If you have any questions, as again I already said, please shoot me a mail, and I hope you enjoyed it. Happy trading. Watch your stops. Enjoy yourself here. Happy weekend, and enjoy yourself over the weekend. And yeah, talk to you again then next week, or already if you want tomorrow in the morning meeting here. Exclusively for JFD brokers, then at 9:30 a.m. GMT on the YouTube channel from JFD. Yeah, I'd really appreciate to meet you there. Have a nice day. See you, and bye-bye.